Well, hello and welcome to another TradeStation educational webinar, another one in our series called Building a Diversified Portfolio of Automated Futures Trading Strategies. My name is Don Prattle. I am the Director of Trader Development and Education here at TradeStation, and I want to welcome you to this event. Our speaker today is Mr. Petr Tmej. Peter has been engaged in trading since 2008, and he specializes mainly in the development of his own robust automated trading systems called ATS. He's got a very deep knowledge of probability theory and statistics, and he's a TradeStation customer. Our presentation today is for educational purposes only. All the symbols and trading ideas that we discuss here are for demonstrational purposes. They are not recommendations. This presentation is not an offer or a solicitation of any kind in any jurisdiction where any TradeStation affiliate is not authorized to do business, including but not limited to Hong Kong and Japan. Active trading is not suitable for everyone, and options trading carries a high degree of risk and is not suitable for all traders. Please read the disclosure information in the PDF handouts we've made available in the chat panel, the documents folder, and you can click on them and open them in another browser or review them on the TradeStation website. Our presentation today is called Building a Diversified Portfolio of Automated Trading Strategies for Futures Markets, submitted to us by AOStrading and Petr Tmej. So I want to turn things over to Peter right now.
Okay, thank you, Don. I hope that everybody can hear me properly, so please let me myself a little bit more. My name is Peter. I'm coming from Czech Republic, Prague, and as Don already said, I'm the, let's say, long-term customer of TradeStation. I'm actually doing live trading, automated trading strategies for quite a long time. And currently I'm also trading on institutional level as with my let's say own hedge fund. So today I'm going to talk about my, let's say, approach how to develop the diversified portfolio of automated trading strategies for futures market. And I hope that you're going to enjoy this presentation, as I do believe that it will bring you many interesting and meaningful information and know-how. As I said, I'm also what I do believe is let's say very interesting about my career is that I switch from, let's say, retail trading to institutional trading, and thanks to the fact I'm used to and I have very good experience with TradeStation platform, we still keep on with that, and we're trading right now with TradeStation platform using many different tools from EasyLanguage to radar screen, trading many different strategies on various types of markets. Today I will focus on trading future strategies, and I'll show you what's the effect of, let's say, trading robust automated trading strategies which are completely uncorrelated, and what's the benefit of that. So first thing I would like to say regarding my experience is that I do believe that many traders underestimate these three things. The first one is that they don't really take care about the over-optimization. Of course, that's the process where you develop strategies on one sample of historical data. You use many different, let's say, conditions, many different trading rules and stuff like that. And then you just make it, let's say, thanks to the optimization, you do many different combinations of the strategies. And once you applied it on out of sample data, you just realize that the strategy is working not very well or is working very poor. The problem of over-optimization is that if you don't know how to properly, let's say, apply the robustness testing, then the risk of over-optimization is really huge. What I really find out is also the fact that, according to my opinion, most of the traders are not very well aware of money management. Most of the traders are trying to target very aggressive approach with very high revenues. But the problem is that when you don't really, when you're not able to quantify the potential drawdown as well as, but the potential real drawdown, not only coming from the historical backtest, the problem of insufficient, let's say, capitalization of your account can be really huge. So these two basic things are, let's say, very important to consider, and according to my experience, as I'm a long-term, let's say, lecturer, this is the one of the main, let's say, issues with retail traders. So what I primarily focus on, as I already said, currently I'm let's say not only portfolio manager but also co-founder of the hedge fund, which is named Quantum Solutions. And with this hedge fund, we're trading, regarding futures, we're trading mainly indices, energies, metals, agriculture, and softs. My experience with TradeStation is really great from the execution point of view, as I have many different experience with many brokerage firms. My experience is that TradeStation platform or TradeStation execution servers are really on the best quality, and thanks to this fact, you can trade not only, let's say, swing strategies, which are trading where the average holding position is around few days, but you can also trade intraday strategies, thanks to the fact that the slippages and the commissions are really low regarding trading with TradeStation. So this is very important fact, and I will explain you later on what kind of strategies exactly I'm developing with TradeStation. Here I can show you later, if there's going to be enough time, example of the live trading with the TradeStation. Here is the example where we did the trading with our hedge fund. As you can see on the chart, there are many different, let's say, charts, which marks many different markets. And if there's going to be enough time at the end of this presentation, I'm going to show you the record of how those trades are executed in TradeStation platform. One of the examples of the trading strategies I would like to present you today is development of intraday and swing strategies. Intraday strategies are those strategies where you keep position open for a few minutes or hours within one day. Each position is closed within one trading session, latest at the end of the day or at the end of the trading session. So here is one example where I'd like to show you the strategy for the platinum. I've got really great experience regarding platinum market, and according to my experience, there are many inefficiencies on this market. So on the chart you can see that there is one part where we develop strategies using in-sample and out-of-sample data, and on the right side you can see the results of the live trading of this strategy, real results with our hedge fund trading. So as you can see on this right panel here, this strategy passed for the experienced one with TradeStation, passed very well the cluster work forward analysis, and this is one of the, let's say, basic presumption how you should evaluate whether the strategy performs according to the expectations or not. What is necessary to add is that in this chart, commissions and slippage for this trading strategy on this market is already included. As you can see here, one of the most important thing regarding trading strategies is that when we trading live, it's very important that it keeps the performance from the in sample plus out of sample price data. So when you can see, one of the most important thing to compare is that I want to see in live trading that the strategy performs similar way regarding the average trade net profit. Of course, you need to have a large sample of the strategies, a large sample of the trades, so you can compare the results from developing the strategies and also from the live trading. The second group of the strategies where I have really good experience are swing strategies. The swing strategies are used for opening and managing long-term trading positions. A position is kept overnight, so it means that you can simply be in the trade for few minutes, few hours, or also for few days. It just depends on the conditions, whether they are met to exit the trade. And these strategies are very similar to trend following strategies. So it means that you're trying to develop the strategies where you cut the losses and you let your profit runs. Swing strategies have usually less trades, higher drawdowns comparing to intraday strategies, and bigger average trade values, what is quite, let's say, advantage, because of course that way you don't need to care too much about slippages as well as the commissions you pay in the market. Another example of these strategies can be found here. It's let's say strategy for gold. Again, as you can see here on the right panel, it passed really well the cluster work product analysis from TradeStation, and last but not least, it also gives us very good, let's say, live trading results, which completely correspond to the performance coming from in sample and out of sample price data series, which are used for development of the strategies. So here you can see that again, what we're looking for is that we have similar, or in better case, better average trade at least, and also of course, you need sometimes in live trading in order to evaluate whether the strategy really, let's say, perform according to the expectations coming from in sample and out of sample data. So how did we do it? How did we do it? The thing is that when we are searching for strategies, we use methods of genetic algorithms coming from TradeStation platforms. As I found out, not many people around who are using TradeStation platform knows that it is possible to develop strategies using genetic programming approach. I will explain you later exactly what it means, but from my point of view, there are several advantages of using genetic algorithms. The first one is that you do not have to become a programmer in order to trade, let's say, automated trading strategies. So you definitely don't need to know programming. According to my experience, what is much more important is that you let's say, understand the statistics as well as robustness testing, so you're able to really evaluate the potential viability of the strategies. The potential is really very important word, because you can never be sure of the future, let's say, performance of the strategies. However, you've got tools as robustness testing tools. I'm going to talk about these tools later. When these tools are used properly, you increase the probabilities of the success of your future trading. What's very important is that when you're using genetic algorithms, you can also, let's say, simplify the workflow with the process development of the strategies. Because simply you can generate many different strategies with many different logics, and thanks to this fact you can really make, let's say, the process and workflow where you can set up the TradeStation the way that you can make many different strategies and test them on robustness testing. The interesting thing about the genetic algorithms is the fact that it's kind of idea maker. Most of the people who are trying to develop the strategies themselves, let's say, they are trying to they're trying to find conditions which are written in the books or which are quite known or general. But what is interesting is that when you're using genetic programming approach, let's say, computer is able to come up with the ideas you would never be able to, let's say, generate or come up by yourself. So it's really interesting. So most of the work is done by your computer, but nevertheless, it's still very important you respect the step-by-step procedure and you try to eliminate the potential over-optimization of the strategies. What is one of the huge risk of using genetic programming if you don't know how to properly use robustness testing tool. One of the example of genetic optimization of intraday strategies on futures in the platform is here. So I would go to screen sharing and show you the way what it exactly means. So I will just start the screen sharing. Go to TradeStation platform. So what you can see here is that we have the here three charts. On each of these charts you can see that we have one for platinum, 60 minutes time frame, the next one is for gold, 30 minutes time frames, and last one is from heating oil, 20 minutes time frames. As you can see, for example, for this platinum, here you can see that if we make a chart bigger, it can be identified that the strategies are intraday because most of them are, let's say, getting out or exiting at the end of the day. And the principle of genetic programming is working the way that in EasyLanguage you're able to pre-program many different conditions which are tested where the combination of these conditions are, let's say, tested by optimization test by TradeStation. Just to explain you what I'm talking about, to make it a little bit more clear, here you can see that, for example, on this chart, you can see that we have some kind of entry prices. So here you can see a number. So when we make it when we order it from the lowest to highest value, you can see that we have the values from 1 to 11. In other words, it means that for these entry prices, we can use 6 kind of different conditions. So for example, one entry price can be a high of the last, let's say, 20 bars, high of the 20 bars ago, or another conditions can be some kind of breakout channel. Another condition can be, let's say, Keltner channels or Bollinger Bands or whatever. So you are able to predefine in TradeStation many different entry prices, and according to that, the TradeStation will try to find out the best one which performed the best on in-sample data. Another one here is, for example, entry conditions. So when we go to entry conditions, you can see again that we have, when we order it, we have, let's say, 19 different conditions. Entry conditions can mean that, for example, when the close of the previous day is higher than open of current day, it means that the condition is met and you can enter the trade when, for example, the entry price is touched. This way you can again test at least 19 different conditions. So, and you can use the, let's say, computational power of the computer, so you can be, let's say, sure that you will try all of the combinations and you will find out the best ones. Another, let's say, things you see here are N1, N2, N3, and ATR and FR. All of those are actually the optimization values of indicators. So you're not only trying to find out the best, let's say, conditions and entry prices, but you can also, during the genetic programming, you can also try to find out the best possible optimization values of the indicators or of, let's say, level of enter prices or level of or value of an ATR indicator. So this way you allow TradeStation to try thousands and thousands different combinations, and what it makes is the fact that it facilitates your job, because if you did it yourself, for example, if you'd like to try all of these combinations yourself and you'd like to program it, you would do it probably for the rest of your lives, because it would be very, very time consuming. As I said, the risk of over optimization here is quite huge, because thanks to the fact you're trying thousands of different combinations, you increase the risk of over optimization, because then when you're trying it on out of sample data and you're trying to verify that the strategy still performs well on unseen data, what we call out of sample, it still can be a coincidence that it performs well on out of sample data, because you tried many combinations. So you just look for the one where it performs well on the out of sample data. So the, let's say, solution for this can be a proper, let's say, application of robustness testing tools. And one of the robustness testing tools, if you know how to apply it properly, is, for example, cluster forward analysis from TradeStation platform. I'll show you, for example, what you can look for. This is the most profiting, let's say, strategy for Platinum. So when I will go to the use strategy performance report, you can see that it's, for example, one of the strategy, and here you can see that it's the most profiting one with this equity curve. On the other side, when you want to see, for example, the worst combinations and the ones which are, let's say, extremely unprofitable, you can also try to look for the one, show you the example that, of course, not all of the equity curves will be profitable. So the key is to look for the one which were performing well in the backtest and which will also perform well when you're going to apply stress tests, robustness testings, and cluster forward analysis, etc. So getting back to the presentation and slides. So just to make some kind of summary, genetic algorithms represent a very strong tool for development of trading strategies. However, you need to keep one important thing in mind when developing a strategy. There is a high risk of over-optimization. It means that you will just overfit strategies and fit it to the past, but it won't perform well in the future. And I was really dedicating, let's say, a lot of my life and a lot of my training career to develop and identify the, let's say, my own robustness testing approach. It's not about the fact that I would develop some kind of new robustness testing tools, but it's rather about the procedure, how to apply a step-by-step process in order to identify this potential over-optimization of the strategies. Because after generating hundreds of potential strategies, you have to check their robustness and find out whether the strategies are not just matter of a coincidence. I mean the performance of the strategies. In live trading, an overfitted strategy is not going to be profitable. That is for 100% sure. So one of the tests which I'm definitely using in TradeStation is proper application of cluster forward analysis. Why I'm saying proper application? The thing is that the cluster forward analysis can be your huge, let's say, help in order to identify the potential viability of the strategy in live trading, but it can be also your enemy if you don't know how to use it properly. If you, let's say, developing the strategies and you don't consider properly what's in sample, out of sample, and what is, let's say, incubation period where you test the strategies on never seen data in order to simulate the live trading environment. If you don't know how to divide this data to these three categories, and if you don't know how to evaluate the results when you apply cluster forward analysis on never seen data, when you apply the cluster forward analysis on in simple data, if you're not able to recognize or evaluate properly what's going on and how to evaluate it, then even you can get the cluster forward analysis which will show you that it passed all of the let's say criteria test which are within this tool, and you will wrongly identify that the strategy is robust. What is also important to mention is that cluster forward analysis, according to my opinion, is the basic, but you need to apply more tests. For example, what I'm trying to do is also multi-time frame and multi-market cluster forward analysis. This is also possible to perform in TradeStation. And last but not least, very, very important are stress tests. The stress test methods I'm using is, for example, that you randomize the prices. For example, just to explain you what I'm talking about, imagine you've got one price data series coming from the past, but it's only one price data series, and you can be 100% sure that it won't repeat the same way in the future. However, we're doing trading, and we most of the traders, or that's the reason why we do believe we're doing that, is that we accept that there are markets which have, let's say, a specific type of behavior because there are different types of market participants. So when you're gonna accept the historical price data series, and you will just slightly modify the price data series according to, let's say, for example, ATR indicator, and you will do many different price series in the past, let's say thousands of potential let's say iterations of this price data series, and you will apply your original strategies on these let's say thousands of possible iterations of price data series coming from past, and the strategies will still perform well on these iterations. You can somehow predict that the strategy is very, let's say, robust from this point of view, and there is higher potential that it can make money in the future. Also, one of the things which can be, let's say, applied is that you're going to randomize the strategy in parts. So when you have the, let's say, values of indicators, what can be considered as inputs, you will randomly change their values, and because you never know if you, for example, have moving average with, let's say, in parts 20 bars ago, when you're using 20 bars ago for calculating moving average, you want to also see that the strategy is performing well if you use 25 bars ago or 15 bars ago. Why? Because you never know what would be the best setup for the future. You know, I mean, regarding the strategy inputs values for the indicators. So you want to be sure that it still performs well on many different indicators, values of indicators. Last but not least, you should also be able to, if you're using, for example, trend following strategies or swing strategies, you can simply start backtesting at the year of 2000, let's say 7, 8, and you will start on 1st January, and you will develop this trend following strategy, which will exactly fit somehow, because you're doing many different, you're trying many different, let's say, kind of strategies. So you'll find the one which will exactly fit to the trends, to long and short trends, or not exactly, but somehow it will fit to the long or short trends from this 1st January. But you want to see that the strategy is so robust enough that it still would perform well no matter what date you would start. This is not an issue for intraday strategy, this is rather an issue for long-term, let's say, swing trading strategies. Last but not least, you have to be able to you also have to be able to make proper analysis of optimization results. So it means that you have to know exactly how to divide the in-sample and out-of-sample data. That's the first thing. And you have to be able to evaluate these optimization results. What's also important is that most of the traders are not using 3D optimization chart. For example, when you have the strategy which got 2 parameters for optimization or more parameters for optimization, it can be 3, 4, 5 parameters for optimizations. You have to be sure that the parameters which you will choose for live trading are coming from the, let's say, global peak area where you maximize the probabilities that the strategy will still perform well in the future. And last but not least, you also have to analyze the trading history of or trades history analysis, where you analyze whether the strategy is rather trend following or it's rather, let's say, it's rather kind of breakout strategy or whatever. So you can be sure that when you do live trading, you still see the distribution of these, let's say, trades in the past, and that the distribution of these trades also corresponds to the past when you're going to live trading. So all of these tools I consider as very important to apply. Unfortunately, not all of them are coming from TradeStation. However, TradeStation is really great in the way that you can export the optimization, let's say, a strategy optimization report, and there you can use all of this data in order to perform most of the tests I presented to you. One of the things I would like to show you is that you can apply, let's say, the positive effect of diversification, because one thing is that you are able to develop the strategy yourself, applying appropriate robustness testing tools, and when the strategy will pass all of these robustness testing tools and you will decide to apply it for live trading, you can try to, let's say, use the effect of diversification, because according to my let's say, live trading experience, I realized that most of the let's say, strategies which are developed only for one market has really high, let's say, standard deviation of their let's say, daily revenues or trades. This is something what is really necessary to consider, because according to my experience, maybe some of the participants of this webinar today will have different opinion, but for me it is almost impossible to find some strategies on chosen market with a low standard deviation. So it means kind of mean reversion strategy where you have really high percentage of winning ratio and really high stability of the results. Because most of the strategies I found out, and I really tried to develop on many different futures markets, many different type of strategies, I find out that most of the strategies have really high standard deviation of the results. What brings us the problem regarding the potential results in the live trading future? Because here is, for example, one of the positive scenario of the strategy, where average daily yield of the strategy is around $69.7, and the standard deviation is 805. For this type of strategy, this is one of the typical strategies with which I'm trading live. I mean, this character of the strategy. What is very significant here is that it can have great results from the backtest in the past. So it can have very stable equity curve, but it was just fitted to the past, so you have to consider the strategy was fit, you were still using out of sample data and stuff like that, and still because of this high standard deviation there is quite a big risk of the fact that you cannot exactly predict how the strategy will develop in the following days, even years. So this could be one potential scenario for the strategy in the future. And still it could have passed all the robustness tests. In the back test it could have had a very good equity curve, but when you're going for potential scenarios of the strategies, when it comes to high standard deviation, it could be this one. What here on the x-axis, on the horizontal axis, you can see the number of days. So here you can see that after 1 year, more than one, almost 2 years of trading, it can still have very positive scenario. But another one positive scenario, but it can also have this scenario. And after, let's say, 1 year of live trading, almost 1 year of live trading here, you can be significantly unprofitable. And in the past, in the backtest, it never show you this way that you can expect this situation. But thanks to the fact that you have high standard deviation of the daily yield, this is the real fact, and most of the traders completely underestimate this this issue. So how we can get rid of that? This is the risk of trading one strategy on one trading market, because another scenarios can be this one, another scenarios can be even this one. So after, let's say, 2 or 3 years of trading, you can still be unprofitable. And this is one of the, let's say, huge problem of trading one trading strategy with high standard deviation. So if you're able to make the strategies yourself, let's say where you have standard deviation under control, which is very low, and it's not now about your daily yield, but you are able to control the standard deviation of the results. There is no worry if you know that it passed all of the tests. You can, let's say, try to trade it on one single market. But as I said, the problem is that I've never found strategy this way on single market, having a strategy with low standard deviation, because really the markets nowadays are very efficient. The competition is really high, and it's more and more difficult to find strategies with low standard deviation. So here another negative scenario, and we're still talking about one trading strategy with potential future scenarios which had very good, let's say, backtest result, passed all of the robustness tests. So what could be the result? When you compose the portfolio, let's say from 10 uncorrelated strategies on different types of markets, the expected result can look this way, because what you do is that it is mathematical fact that when you, let's say, apply the strategies which are completely uncorrelated, Of course, you can measure the correlation of the strategies by the correlation coefficient. It's not, let's say, not the part of this webinar. It's quite comprehensive, let's say, field. But the fact is that you can measure whether the strategies are correlated or not. So it is mathematical fact that if you put many, many different uncorrelated strategies to one single portfolio, the positive effect of the diversification is that you decrease the standard deviation of your revenues from the long-term point of view. So here is one of the potential scenario you can expect if you trade 10 uncorrelated strategies. This is just the first scenario. Another one. So you see that actually trading diversified portfolio of uncorrelated strategies can also bring you, let's say, the negative scenario in the future. So you just wasn't lucky enough. But on the other side, these scenarios are much more rare and let's say very, let's say, unique, which can happen in your live future trading. So what I learned from, let's say, my personal trading, from becoming, let's say, retail trader coming to institutional trader trading level, is that thanks to I started trading myself, let's say, in the beginning of 2013, and I was just trading with, let's say, one strategy, then I added another strategy, and I was trading with 3 strategies, and those time I found out that let's say, the effect of diversification wasn't very good, but on the other side, I can simply say nowadays that I was lucky enough that I made still good profits because I had, let's say, good strategies. But on the other side, it was also the matter of luck. Nowadays, with my hedge fund, I'm trading on futures market. I'm trading more than 20 different completely uncorrelated strategies. What brings you the stability to your, let's say, results, because all of them are completely uncorrelated, and that way I'm able to, let's say, make the live trading results more stable. It is not about the revenues, it is not about your average revenues per year, not about some kind of aggressive approach. Of course, you have to control your money management and stuff like that. It's really, really the matter of proper diversification using uncorrelated strategies. So as you can see, this is coming from the experience of trading one strategy, where you see that the potential outcomes and the results of the strategy are very, let's say, unstable, comparing to trading portfolio of, let's say, diversified trading strategies. So next to the potential higher stability of results, trading by the use of a portfolio of trading strategies can also bring a potential higher profitability, because you don't, with the possibility of same or even lower average drawdown. This is fact that, for example, when you have many, many different strategies which are completely uncorrelated, it doesn't necessarily mean that you have to increase your drawdown. It still can mean that if it's uncorrelated, you can keep your drawdown very low and increase your potential of profitability. So you actually, let's say, improve your ratio of average revenues per year divided by maximum potential drawdown. So I see that we are at the end of the presentation. I'm glad that I somehow make it in 45 minutes. If you'd like to learn about the construction of portfolios, I offer an advanced course. In the advanced course, I can teach you how you can easily and efficiently search for the automated trading strategies. So I can simply teach you the way how you can make strategies yourself using kinetic programming approach in TradeStation. I can also teach you how you can measure the correlation between the trading strategies the effective way, because I created an automated tools which can, let's say, export the data from TradeStation for each strategy and then make the quality correlation analysis in order to identify whether the strategies are appropriate to trade as the portfolio. And last but not least, I'm also teaching how to make and how to, let's say, evaluate the robustness of the strategies in order to, let's say, evaluate its potential viability in live trading. And also I teach how to determine the appropriate capitalization for the trading. It always, let's say, depends on your risk profile, on your target, on your revenue targeting. So you can also, thanks to the futures trading and possibility of trades with margins, you can simply, let's say, identify or not identify or determine if you want to make more aggressive approach with potential high revenues, or if you want to be more conservative. So all of these things can be, let's say, applied. Thanks to the fact you joined the course today, I'm able to offer you the 30% discount for the advanced course. So in case you'd be interested in much more in my, let's say, strategy development process and composition of uncorrelated portfolio strategies, I'm very willing to provide you more information. If you want, you can go to my website, AOStrading.net, where you would find much more information. So thank you very much for your attention. I hope you enjoyed the webinar. And if you had more questions regarding what I was talking about today, not only about the course, but about my approach, I'm very willing to make, let's say, a personal Skype call or whatever with you in order to explain you my personal approach to trading. Thank you very much for your time. I hope you enjoyed that, and hope that you understood my English properly, as I'm not a native English speaker. Thank you very much. And I don't know, Don, if you have some, let's say, something to add, or what's going to be the next procedure, as it's my very first presentation.
Well, first of all, Peter, what I just want to thank you for your presentation today. You covered some a very detailed topic, and explained a very, you were very explicit about your trading rules and your strategies. So we want to thank you for that from TradeStation, and we want to thank all of the folks that attended today for their time. And we hope that we can schedule another event down the road some other time.
Okay, that would be great. I will definitely prepare some, I can definitely prepare some more detailed information, and let's say point out one of the things which can be interesting. Like, for example, I can try to talk a little bit more about my approach to customer reward analysis, how I'm using that a little bit more in detail, and presenting to TradeStation clients. That would be great, for example. One of my idea.
Before you leave, Peter, there is a question from Frank in the chat panel about the first strategy that you were using, the intraday strategy. It gets results very differently versus live trading.
Yeah, I can go back for that, and which strategy, Frank, do you exactly mean? I can try to explain. Yeah, it's, for example, yeah, you mean swing strategy or intraday strategy? Yeah, I see. So here you can see that this is in sample plus out of sample. Frank, I don't really understand the question. In live trading, the most important part of your profit comes from long side. This is the example of the trading strategy with which I'm trading live. As you can see, this is for the platinum one, and here you can see that in live trading, it's performing well on long side as well as on short side, because this is one of my basic rules, that I want to see that the strategy are performing well not only on long but also on short side, and it's kind of symmetric. Of course, you cannot expect that it's going to have the same performance on both sides, but this is one of the way how you can eliminate the phenomenon which is called long or short bias in the markets. But in the, let's say, yeah, here you can see that profit from in sample plus out of sample is coming from long side. But this is exactly how you know, this is very good question, and actually I covered this let's say issue in my advanced course, because one of the most important thing for myself is that you have to eliminate the long or short bias in the markets. And the way how I develop the strategies is always that the conditions are symmetric on the long side as well as on short side. So I definitely don't agree with the premise, for example, as some of the traders do, that you could have, for if you trade strategy, you would use different parameter values for long side as well, for example 20, and on short side, for example 40 for moving average. This is not what I'm doing. I'm always looking for symmetric, let's say, trading conditions. And why we don't see the same performance in live trading as well as on long trade or short trades here? The reason is simple, because markets are changing, you know. For example, platinum could have been the market which was rather long biased in this period, so from 2010 to 2013. So as you can see here, that was one of the reasons why it was much more profitable on long trade. But from in the live trading mode, when we started in 2013, there was much more opportunity to trade on short sides, because the platinum, of course, let's say, fall down and the price fall down. And in the next 3 years, it can simply change again, and it can make more money on the long side again. So the main principle is that you cannot expect that when you will get the backtested results and you are 100% sure that the strategy is long short symmetric, what is one of my first condition when I develop the strategy, and first one of the most basic rules. It doesn't necessarily mean that it will perform the same way also in the future, because the markets are changing and they can change from long bias to short bias. But one of the way how you can eliminate this long bias, short bias phenomenon is really that you ensure that the strategies are symmetric on both sides. Yeah. Thank you, Frank. Don, do you think there are more questions which
No, that
I
actually
should answer, or?
No, that looks like you have answered Frank's question. That was the burning one that I saw. So, you know, and as you pointed out, Peter will absolutely set something up if you think of a question and you'd like to contact him directly. As all our other webinars are concerned, we are recording today, and we will have this presentation ready sometime early in the week. Next week, we'll have it posted on the TradeStation video station and on the YouTube channel as well. So these you'll have the ability to review this, and if you need to reach out to Peter, he's available at the email address on the screen right now.
Okay, that is great. So thank you very much, Don, for this opportunity. I really appreciate it. I hope that all of the participants enjoyed the presentation, and I'm looking forward, let's say, hope in the near future to come with some more interesting stuff. Okay?
Very good. Thank you.
The name of there is a question. The name of the hedge fund is Quantum Solutions, and it has its domicile in Liechtenstein in Europe.
Okay. Thanks very much, Peter. Let's have a great trading day tomorrow. All of you TradeStation traders, or overnight if you are a futures trader that partakes in the overnight markets, we will be happy to see you tomorrow at our morning market briefing with should be Sam Seiden from the Online Trading Academy. Let's have a great day, great night, and we'll see you tomorrow.